Today, I'm going to show how we and you can gain 30% profit from just 6 trades, all with sniper entries and 0 drawdown to have really nice profit, minimum risk and huge reward. I gave out this level around this time. When I woke up in the morning, my level had been hit. One trade up here, 3%, one trade here, 8%, another trade, 8% and 1%. 1, 2, 3, 4 trades, and in USD, 5, 6. So 6 trades, 5 wins, 1 loss. All these trades that I'm going to show you are given to our members in advance, hours or days in advance, using our unique sniper level entries. Sniper entries are pinpoint entries from tops and bottoms, putting us straight into profit with 0 drawdown and maximizing the profit. In today's video, I'm also going to show how my last video showing you how to use the range tool was implemented to get the 30% profit from these 6 trades. Again, showing you how important and useful that tool is. Out of the 6 trades I'm going to show you, there was 1 loss because there's always going to be losses, and part of what we talk about in our psychology video. No matter how good you are, there's always going to be losses. But today's video touches on the psychology again, and our previous video about bullish and bearish engulfing candles being the most manipulative in the market, but also how you need to minimize your losses, minimize the risk and have the huge rewards. As I've said before, most retail traders will hold on to a losing trade. When the market goes against them, they'll hold on to a losing trade, hoping it will come back, and that never ends well. But when they're in profit, they'll close that profit early. But what you have to do is the complete opposite, and what we'll show you today. 1% risk, yes, we had a loss, but you take that 1% loss on the chin. You take the loss, you move on to the next trade, and the next great opportunity comes along. Don't worry about having a loss. You're always going to have a loss. You're always going to lose in trading. That's part of the game. But take your 1% loss, keep the risk to a minimum, and then when you're in profit, hold that trade longer. Now, a big part of the problem with holding the trade is retail traders having confidence. And the confidence, or the lack of confidence, comes from not understanding the market fully. But when you really understand exactly what the market's doing and how it really works, you then have the confidence to hold these trades a lot longer. You understand the tricks of the market, the manipulation of the market. When you're in a long trade and you see price might start to pull back, when you understand fully how and why the market is making these moves, you don't need to worry or panic. You can simply keep holding because you understand what's really going on. You understand the manipulation, you understand the tricks, and you can see it for what it is, and it gives you the confidence to just hold your trades longer. So 6 trades, 1 was a 10% trade and 2 were 8%. And again, just for 1% risk, reaching into 25–30% profit for just 5 winning trades and 1 loss. So today, I'm going to jump onto the chart, show you how we've done that, and again, showing you how you can keep it simple and using the innovation principles, some of what we'll show you today, others that are obviously within our app for our members, but how using those and keeping it simple, keeping the risk reward correct, keeping the risk management correct, and understanding the manipulation in the market that we've spoken about in our previous psychology videos can help you gain great profit. Okay guys, so let's jump straight into the chart. You can see on my chart in front of me, it might look a little bit messy, but I assure you by the time I finish this video, you're going to have a full understanding of everything that's in front of us and how we understood to get these trades. Now, this is GBPUSD. We can see here my risk reward tool. There's an 8% move that we caught. There was a loss here, which we'll also run over. There's also another 8% move up here. Then we go to EURUSD. There's a 5% short and there's a 10% long. Notice the numbers and the exact levels on all of the entries. Here, sniper entry, here, sniper entry, and on GU, the same thing, sniper entry, sniper entry. And just to note that these sniper entries are given in advance. So each time they're sent out hours, sometimes even a day before, because we know where price is going to come to. So it's always a pending order, not a market execution, a pending order, which is great because it allows you to not have to be in front of the computer and let the market do its thing. So let's jump into these, and I'm just going to take it back to this area over here. And what you can see and already notice is that there's a lot of ranges on my computer. And this is because we use ranges a lot. I'd done a video recently about a month ago on this channel which showed how to use ranges. You know, some people may not have even clicked that video just thinking ranges, why do I need to know about ranges? I know about ranges. I assure you, if you go back and watch that video, you're going to see how important they are. And I'm going to show you again today. So let's take it back to the first 8% move over here. And if you have watched the previous video on ranges, you'll understand what I'm going to go through here as well. So what we saw on GBPUSD was price went up and made a definitive high. That means that there is potential resistance in this region. There isn't resistance. You can't call this resistance until price goes back for a 0.2. So here was a definitive high. Then price came back down and made a definitive low. Again, that's not support. There's no support to the left. But when price comes back to that, then we can call it support. So at that point, we identified that there's a high and then there's a low. We identify the top of the range, the bottom of the range, and then extend this range into the future. What we're then waiting patiently for is for price to come back up to the top of the range or the bottom of the range. In the last video, I showed how we can enter from the top of the range. At times, it depends on what the market does at the top of the range or the bottom of the range. Remember, these are resistance areas and support. In this instance, price pushed up, took out the high, and then we were looking for an opportunity to short. When price come up and took out the high, it took out the liquidity in this area, which is why I've highlighted it with this green highlighter tool. This is taking the liquidity from above this prior area here. Price broke to the upside, bringing in buyers, and then quickly reversed to the downside. So this was a false move. And as we showed you in the last video, when retail traders trade ranges, they buy on a break of a range, and their stop losses go to the bottom of the range. So this was a fake out and a false move to the upside. But this is where we're looking to enter the market for our sniper entries. In this instance, there was no sniper entry here because price sold off quite hard. We were watching at the time. We said to our members, you know, price can pop back up into this region. We can start to look for a short trade. Liquidity has been taken and some other reasons. You know, I can't give everything away, obviously, from what we give to our members, but I'm giving a good majority of understanding of how to look at the market. But we have innovation principles and methods that we adhere to and wait for price to fulfill those before we look at entering. So we're looking for price to pop back up, but it never happened. And what happened is price actually started to sell off quite hard here. Price started to sell off, and then it looked as although that the potential short trade may not happen. But that's where patience comes in. Then what happened was price within this range. You can see here there was a high, the low, the high. Price came down, and we were waiting for that reversal or that retracement back up. But it never happened for a while. Price then went into a new range. So we highlighted this high, we highlighted the low, and price was trading within a range. Then, eventually, price started to move and break to the upside. In our last psychology video on this YouTube channel, we spoke about how bullish engulfing and bearish engulfing candles are the most manipulative candles in the market. Why? Because they make retail traders think it's a sign to buy, like this big bullish engulfing candle up here. Bringing retail traders in to buy. Before what happens, price rolls over to the downside. Now, there's more to it than that. Obviously, I said in that video, if you've watched that psychology video, I said, when I see a bullish engulfing candle, I get excited to sell, where most retail traders will be looking to buy. You can see here, this would have brought in a lot of retail traders buyers as price broke above this area of resistance here. But this was just simply breaking a range. And again, as we've got drawn on here, taking liquidity from the top of the range, just like it did over here. But this overall range here, price is taking liquidity. So in our recent video, we've explained that price will drive down to the bottom of the range once it takes out the top of the range. So we're expecting price to continue down to the downside of this range. So we're looking for price to come down here and fulfill the bottom of the range, which you can see it does over here. So that understanding that price took out the top of the range makes us understand that our target is going to be the bottom of the range around this area here. So when price went into a new range, price will usually, the majority of the time, make a false move out of a range first before the real move. So it accumulates orders here. Buyers and sellers jumping into the market, trying to figure out where this is going. Price will then go boom, up to the upside, bring in buyers, think it's going to go and fly. What happens? It reverses sharply and comes back down. First of all, there was this mini range here. So as you can see, it took out the high of this range. So the first target would be to target the bottom of this mini range here, where we've got lows, 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 lows. Why? Because as mentioned, when retail traders see a bullish engulfing candle up here, they buy, and where do their stop losses go? Down here, below the range. That's what they're taught. It's not their fault, that's what they're taught, but it's all lies. So price then goes and runs to the downside of the range and takes out the liquidity at the downside. So that was our first target because we shorted here. I'll explain more why in a minute, but we shorted here at 1.33961. You can see basically zero drawdown, sniper entry. And then we knew the great thing about ranges and understanding the range tool is we knew that once we entered here, we had confidence. Even though price, you can see here, pull down, pull back up, then push down again, then pull back up, then push down to the bottom of that range. That was our first target. Then swiftly reversed. We still had confidence. Why? Because we knew we could target the bottom of the overall range. If we remove this range out of the way, and then we just pull this across like I spoke about earlier, you can see that that was our target down here. But again, we showed you in the last video that, you know, this is point 1, this is point 2. This is price having a fake move to the upside, bringing in buyers. And so we were happy to hold, knowing that price was just bringing in the retail trader who now see this as support. Remember a few moments ago, I said there isn't resistance or support until point 2. It's amazing that, you know, price will do this here, just spike down and push up. But retail traders think that that's support. It's not support. You need 2 points to create support or resistance. Because look, to the left, is there an obvious area of support? No. But retail traders think that that's support. So this is the beautiful trick, that when there's a range here, when price comes back down to that level again, what do retail traders think is happening here? Let's just move that risk reward tool out of the way and then zoom in on this range. What do you think is happening here? Retail traders, they notice that there's a support, price pushes up, bullish engulfing, bullish engulfing, bullish engulfing. Oh no, price is running away. I must enter this now. What do? They enter here, here, here on the bullish engulfing candles up. They enter, enter, enter. Stop losses go where? Below that low. So obvious. What does price do? It comes back down to take them out. And that's why we were able to hold for that full 8% profit and take profit there, because we knew that retail traders were getting tricked and that price is coming down to liquidate them. Now, within this area as well, and we just look at when price sold off, the other problem is when price does sell off like this, most retail traders, just like when I just mentioned here, when price starts moving up to the upside, they can't wait. They have fear of missing out, so they jump into the longs. Just like here, where price took out and made point 2, resistance here, started pushing down. We wanted to enter up here, but price didn't do that for us. It just started setting off. Doesn't mean that we get FOMO and start jumping into the market here with really bad risk reward, jumping in anywhere down here. We wait. You're patient. You wait for the retracement. Now talk about retracements. We get the Fibonacci tool out. Here is the top of A, B down here. And we can see where price came up into the 78.6% retracement where we shorted. And then if I just go and center this, so you can see that this is A up here, where price took out the top of the range. Then we've got here, B, C retracement. See that 4-hour bullish engulfing off the 78.6. We shorted there, boom, down. Where do we take profit? Look at that, absolute perfection on the Fibonacci, minus 61.8%. 8% profit, lovely stuff. Now we actually called price to move back up from here as well on GBPUSD. We actually called for price to move back up. As price pushed back up here, we did look to re-enter for a shorter term move. It was very high risk, and we explained it to members. But as price came back up here, we thought we might be able to get a nice sort of 4 or 5% move before an overall move back up to the upside. We knew price wanted to go back up. Why? Because after we took our profit here at 8%, price had taken out the bottom of this range. We just come down, we just liquidated. So price, like I showed you in the last video, we expand the range. So What does expand the range mean? Well, this is the new high. So we remove that and we expand that range to the upside. And we can see that price, now that it's taken out the bottom of the range, where is it going to target? It's going to target the top of the range. So here is where retail traders start shorting. So you can see we shorted here. But then when price breaks here, this is where retail traders start shorting because they see a break. I'll just remove this for the moment. They see a break of support, break of a range, or break of support. Probably not even really looking at the ranges, but to see support, big bearish engulfing candle break. Like I said in our most recent psychology video, the most manipulative candles in the market are the bullish and bearish engulfing candles. Price broke to the downside. That's when most retail traders start shorting. Stopped above the highs or stopped above the range. The range we were looking at, where does price go? It goes back up to the top of the range. That is the target. So you can see here, it made its way up. Now here, we did look for a cheeky intraday opportunity. I just put that range risk reward tool back on. We did look for an intraday opportunity from this area here, and we could afford to because we just made 8% on this move. So price is coming back up to our area again. We were looking for a 5% move or so before looking for a new long back up to the upside. Unfortunately, that one actually got stopped out, so that was a minus 1%. So we had 8% here on GBPUSD, perfectly played out. Liquidity taken from the high, Fibonacci retracement, came down, took out the low, 8% profit backed. Beautiful trade. Then we did look for a high risk. As I said, we explained it was high risk because we knew that price was eventually going to come up towards the top of this range. But we were looking for a retracement down. You can see we had this big bullish engulfing candle up here. Looking for a bit of a retracement down, and so we could use that then to hedge and go for a long back up to the upside. So we had minus 1% there. So plus 8, minus 1, we're 7% profit up on GBPUSD. Now, let me show you the beauty of what I'm showing you today. Let's look at this again. Price makes a bullish run up, makes a high. Very similar to what I showed you over here. Price made a bullish run up, made a high, definitive high, definitive low. Now let's look at what price is doing up here. So we've had that 1% loss. That's fine. That's part of trading. And as all good traders know, you're going to have losses. Accept them. What most retail traders don't do, and the most problem for retail traders, is they hold on to losses. This is a massive, massive problem for retail traders. And one of the main reasons why so many retail traders lose. They hold on to losing trades and then cut their winners short. So when they get into a winning trade like this, they'll take their profit because they don't know how to read the market. They don't have confidence to hold. And they panic when they're in profit. But then when they're in a loss, like this for example, instead of cutting the loss and just having the 1% loss and moving on and looking for the next setup, they'll hold this loss. They'll hold it, they'll hold it, they'll hold it, they'll hold it, and price will just keep moving against them. And for example here, you've probably all been in this situation before. You're in deep drawdown. As you can see that you would have been here if you held a trade, for example, then it looks like it's going to come back to your break even. And next thing, it takes off again, and then you're in more and more drawdown. That is just insane way to trade. You have to cut your losses early, accept the loss, no matter how long you've been trading. Whether it's 15 years like me, or 50 years, or 1 year, it doesn't matter how good you are, you're always going to have a loss. So, and it's about risk reward. So just take the loss on the chin, move on, leave your ego at the door. Because if you start holding on to losses, you're never ever going to be a successful trader. So here, 8%. So we could afford to have a bit of a high risk move. Didn't work out, minus 1%. Doesn't matter, we move on to the next setup. Now, as I mentioned, here, the exact same scenario. Here, price pushed up, made a definitive high. Over here, as you can see, then made a definitive low. Price here, made a run up, made a definitive high. So we get the range tool out. Definitive high, definitive low. And then we wait. We're patient. We're patient. What are snipers? Think about snipers. A sniper. How patient are they to wait for their kill shot, to wait for their trade? Are they, shooting non-stop? Or are they just sitting there waiting patient, waiting for the right trade? That is what a sniper is. So here, we definitive high, definitive low. Not jumping in with all the noise. We're waiting. Then here, price pushes up, takes out the liquidity once again. The exact same thing as over here. like we drew on over here, we can see that when price came up, took out the liquidity here, and then sunk back down. Then what did we do? We looked for an opportunity. So here, price took out the high, sold off. We had to wait again. Price came up for a retracement. Let's look up here. Range tool, definitive high, definitive high, definitive low. Price came up, took out the liquidity from the high. We understood that liquidity was taken. So now we could see price start to push back down. So we start to look for a short setup. Within this short setup, just move this across. Now move this back for a minute to make it clear. After liquidity was taken from the top of the range, price started to sell off. Again, we had to wait. So we said to members, once again, when price sold off here, 4-hour bearish engulfing candle, we said we're going to look for a short opportunity. Ideally, I wanted to short up here. The closer to the top of the range, the better. So I was looking for price to pop up here, give us our principles and methods to be adhered to so we could look to enter. It didn't happen. What did happen? Big 4-hour bearish engulfing candle. This was on Friday, ahead of non-farm payroll. Non-farm payroll came out, this big doji candle. Big move up, big move down. What does non-farm payroll do and high impact news? It accumulates retail traders into the market. It accumulates buyers and sellers into the market. Then they're stuck, hoping for a quick fix, looking to get rich quick. Then now they're stuck in the market. Price continued selling off. So we wanted to short up here or anywhere up here, or maybe even above this high for a sniper up above here. But in this case, price didn't push up higher like I wanted. It actually found resistance and sold off. I had to be patient, like a sniper, and wait for price to come back. So 4-hour bearish engulfing. What did I say about candles? 4-hour bearish or any bearish engulfing or bullish engulfing, the most manipulative candles in the market. This brings in a huge amount of short selling. Then we had the doji candle, which was a huge wick up and wick down on non-farm payroll, and then it could continue pushing to the downside to take out the non-farm payroll low. Tip, price will always want to go back and take out the non-farm payroll highs and lows. The same thing with FOMC and the same thing with CPI data. So price took out that doji candle low, which would have brought in some more sellers as well. Then that was Friday and we went into Monday. What we can see here is we were patient. We waited for our move back up and we waited for a retracement back up to the upside so we could short. Talking about retracement, we get the Fibonacci tool out. What happened? Let's just zoom in here a little bit closer. You can see liquidity was taken from above the range. Price came down, returned back in. Look what happens here. 4-hour bullish engulfing. Retail traders, what they led to believe. If you see a bullish engulfing candle, you think that price is going to push up higher. Here, bullish engulfing into the 61.8. Where we entered, you can see my sniper level there, given out in advance, 1.35759. Price hit this level and rolled over to the downside. Again, hitting the Fibonacci extension for another 8% trade. So here you can see the exact same thing has played out twice. By using a range tool, understanding liquidity has been taken. Here, liquidity taken, sell off. Retracement back up into 78.6, went down, fulfilled the Fibonacci extensions. One example of the same setup, same type of setup. Here, price pushed up, range high, range low, took out the liquidity, just like here, 0.1, 0.2, liquidity grab, which is why I got the green highlighter tool here. Here, liquidity grab, green highlighter tool, price sells off, retracement back into the 61.8%, and then we sold off for the Fibonacci extension. Again, let's drop down to the 1-hour time frame now, just zoom in here. That move, again, was another 8%. We actually entered this with a 15 pip stop loss. Now, I'll just show you this here. This is that 4-hour doji candle I showed you. This is it on the 1-hour time frame. If you see the bottom of my screen, that's 1300 hours, 1 o'clock on Friday. That's the non-farm payroll high here. And then it came down to make this low. So high and a low. That's the doji candle, effectively creating another range as well. But we just use this as resistance. Well, actually, I use it as a range just to show you the range tool, how important it is. So here, that was Friday's high on non-farm payroll. Tip, price would always want to go back to the non-farm payroll highs, which is here, or the non-farm payroll low. Eventually, we'll go back and retest them. Here, Monday morning, price pushes up, during the Asian session, sells off slightly. It goes back up to the top of that range, take out the top of the range, 1 hour, 4 hour bullish engulfing into our level, into our Fibonacci retracement 61.8, and then set back up to the 4 hour time frame. And we can see that here, price went down to hit that 8% again. So it happened yet again. Now here is where it gets interesting one more time as well. Just remove this range from here. If I just carry this range across, now remember what I showed you in the last video on how to use ranges. When price makes a high and a fake out of the range, you have to expand that range, so up to the upside. So then what we saw was that price came back up after we had this short and hit 8%. What did the price do? This time, it didn't actually make it all the way down to the bottom. I had a retracement back up. Price came back up to the top of the range. So given what I've just showed you today, what would you do now? You would probably do exactly what we done. The same thing as we done the 2 times prior. Here, liquidity grab, price sold off hard. We didn't jump into the market. See how it done the same thing again. Bearish engulfing candles. What do they do? What you probably have done this before, because we've all been there. We learned the retail mindset, but now you have to unlearn it. Big bearish engulfing candle, you're taught to sell. And then your price might go into your favor a little bit, or you might be waiting for a pullback, but then price prints another bearish engulfing candle, and you get the fear of missing out and you jump in, and then price goes back up to the upside. What we've done here, and what we told our members, again, you can see liquidity grab. Don't jump in. Don't have the fear of missing out. Wait for price to retrace. Talking of retracement, we get the Fibonacci tool, and then price came back up. 78.6 comes down, Fibonacci extensions. And this time we knew it was going to come back down. We had another drive, another liquidity grab, which was more bearish momentum to come down to the bottom of this range. Over here, that's the start of the original range when we had the definitive high over here where we begun, and the definitive low. So we came back down. Here, what happens? Starts printing some bullish candles. Buyers come into the market, comes back down. Takes out the liquidity. And what happens here at the bottom of the range? Because this looks like support, this is where retail traders start selling. But this is where you should be buying, and why we told you about the range tool. So going back to this quickly, because I need to then jump over to EURUSD. Here, we didn't actually sell this ourselves. Why? Because we took EURUSD instead. I saw this setup, gave this to members, because we don't only just show the trades, we also give analysis across 10 different pairs. For example, on gold on Friday, we gave a level that gold would hit, and it completely died from there. We give out this analysis as well. So you can use our course lessons, our innovation methods and principles, along with our analysis, and also take your own setups. But here, on this one, we did take this setup, but we took it on EURUSD. Because if you trade GU, it's very, very similar to trading EURUSD because of the correlation between the two. So on Monday morning, it was the same thing again. This was also a Monday morning. You see the bottom of my screen. Again, I've mentioned this on and I can cover this a bit more if you'd like me to. Let me know in the comments. I talk about timings in the market. This timing here, you can see that bullish engulfing candle here. That was at 2 o'clock, a specific time. Here, the price pushed up was at 9, 10 o'clock, a specific time we teach members about. There's certain times in the market. Here, again, if you look at over here, I'm going into lots of detail, so I'm assuming that you guys will like this, so I'm going into a bit more detail. But here is where we said that there was a range over here, because this was the non-farm payroll high, and that was the non-farm payroll low. But see how price came up, 1, 2, and then we drove up to take liquidity out of this mini range. So that's where we entered here. And of course, the first target was the bottom of this mini range, and we got 8%. Well, again, copy and paste almost. Over to here, we were looking to short around this region because this is where liquidity was taken. Price pushed down, came back up. There's a range. This was 5 o'clock on Friday. Don't know about you, but I'm not looking to enter the market at 5 o'clock on a Friday. So what happened? This was also Friday over here, non-farm payroll. Price pushed up on Monday morning. See the bottom of my screen, 10 a.m. Monday morning. Then here, price pushed up 2 o'clock on Friday. Took out the high, hit our Fibonacci level, and hit exactly where we said. Because we told members, again, an innovation, method, and principle, we can't give everything out. There's reasons why price was going to come up and take out this high and come into that 78.6 and then roll over. That was another move to the downside, but we did capitalize on that, but on EURUSD, which I'm going to get to in a minute. So here, so far, we've had 8%, minus 1%, and then plus 8% here. Then, as we can see, price, and let me just clean this up a little bit. So this is now the new high of the range because this is the high, so you have to expand that. And then here is the low of the range, which was our target. We didn't trade GU directly, but we did by shorting EURUSD. So by watching what GU was doing, we also knew what EURUSD was going to do. Now, if you go back to my range tool lesson and what I've been talking about today, you can see price came down here, came down to the low, brought in some buyers who would have jumped into the market here and then came down and liquidated it. Here, we can actually see that this was on Thursday. So price pushed back up at the end of the week. Let's go to the daily time frame, see how that looks. Does it show it too clearly? But this was Thursday. Actually, the daily shows this very, very well. 0.1, 0.2. This is a morning star formation, a very manipulative trick by the market to bring in buyers and sellers into the market because retail traders look at that bullish engulfing and start buying. That candle pushed up to induce more buyers after the bullish engulfing. This candle, when it pushed up, this wick, when that was created, that was a full-on bullish engulfing candle, and then it changed to a doji candle by the end of the day on Friday. Then on Monday, it took out that low. And we effectively, as mentioned, we effectively took a long trade from this low down here. Now, what do I mean by that? Just as I said, we did call this short trade from up here, but we took the short trade on EURUSD because the two pairs have positive correlation. We then also took the long trade from down here. Not directly on GBPUSD, but if GBPUSD is going to go up, so is EURUSD. And we've got a new trade up here, which I'll get to in a moment. But now that I've been talking about EURUSD, let's go to that and look at those sniper entries as well. So as I mentioned, we effectively shorted GU here and longed GU here as well, except we've done it on EURUSD. Let's take a look. EURUSD. So at that time, when GU was here, you can see Monday the 16th of June at the bottom of my screen. EURUSD. Monday the 16th of June, bottom of my screen. Because the two are going to do the same. Many retail traders might not even know that. Little things that maybe we overlook in our videos, but just to explain it. So here on EURUSD, sniper entry, again, level given out in advance. We wait for the price to reach our level. But look at the fashion in how it happened once again. See the bullish engulfing break up into it? As we teach in our psychology course on YouTube here in our last video, a bullish engulfing candle and bearish engulfing candle are the most manipulative candles in the market. Bullish engulfing the candle here, so many retail traders would have started buying. And you can see that price flipped to the downside. You see the same thing as what I mentioned on GBPUSD. Price retraced into the 78.6. And then what did we do? Have a look at this for absolute perfection on the Fibonacci. Given that this is A, B, C at the 78.6. And then let's just pull this across a little bit more. Can you see D, the Fibonacci extension? Pinpoint. Bang. And what was this trade? This one, because we entered with a swing trade entry, which for us, we gave this a swing trade entry with 30 pip stop loss because we needed to give this a bit of room to breathe in case it did try and squeeze up a little bit higher, but we need to give this a little bit of space to breathe. Then we came down and hit 5% profit. Now why? Let's have a look at this. Let's just zoom back out to the daily quickly. Over here on the daily time frame, again, effectively, another huge range. Price is in a range over here. Price dropped to the bottom of the range. Big fake out down here. And now it's gone back up into the range. So this is the bottom of the range. Sorry. And this is the top of the range. But let's just use this as resistance here. So price came up 0.1, 0.2, and therefore at 0.2, as you can see here where my arrow is, and that bullish engulfing candle, again, see everything I'm saying is just repetitive, repetitive, repetitive. Look at that bullish engulfing candle that broke the daily resistance. Most retail traders, it broke on the 4 hour, most retail traders will be taking the long trade there. This is daily resistance, drop down to the 4 hour time frame. Look at that strong breakthrough on the 4 hour time frame. Very, very strong, bringing in a lot of buyers into the market. And then what happens? It reverses. But there's something about these candles that we teach, innovation methods and principles. They're very, very important as well to understand what's going to happen next in the market. So here, price came back down. It grabbed liquidity from 0.2, just like I showed you on GU at the top of the ranges. So therefore, we were patient. The patient, price started selling off. Okay, that's fine. We'll be patient. What does a sniper do? It sits and waits and waits and waits and waits until the time is right. Price pulls back, hits a 78.6, and we sell off. And as I just showed you, hit that level to absolute perfection on the Fibonacci extension. Also, if I just take away that resistance there, you saw why price sold off, took out the liquidity. But again, on the lower time frames, another mini range in here because price has made a low and a high here. 4 hour bullish engulfing. Price came down, pushed up, took out the high of that range. First target was here. That is why price found support here. But again, brought in some buyers just to go down a little bit lower and take out the low and hit that 5%. Then came the biggest trade that we've had over the past few weeks, 10 to 1 risk reward. Now, I think you're going to say, well, why did you enter that trade? Why do you think I entered this trade here from what I've just shown? Well, first of all, we saw that Fibonacci extension fulfilled. Also, we understand that there's a range tool here. So if this is a definitive high, definitive low, came down 0.2, price pushed up a little bit here. This was 0.1, 0.2. Remember, price doesn't create support until it makes 0.2. Again, here, that's not support. That's just where price has rejected an area, a level. That's not support. When price comes down and then rejects this area and then starts to move back up, then retail traders think, oh, this is support. It's not. It's just making you think it is. Price pushed back down into where we longed, because here is 0.1, here's 0.2, price pushed up. We expand the range like I showed you in the last course lesson, and then price came back down to take out that low. Here, we're taking liquidity from the low of this range. Plus, USD is bullish overall, so we want to look for a move back up. Plus, go back to the daily time frame. There's other reasons that I can't give everything away, but I'm trying to do as much as possible. We knew that price, again, there's innovation principles and methods. We knew that price was going to go higher. So this short trade was actually a high risk move, but because we knew that price was going to go higher. There's reasons here within this, candles, etc., why we know. So when price then came back down to take out the bottom of that range, we knew it was time to switch and go long. Because again, let's just take the bottom of this range. Let's just take this as an area of support. So you can see support, support. When that broke, and we start to break down here, that's where the retail traders start selling. And also, another thing to add, high impact news events, non-farm payroll, FOMC, CPI, they are where the market tricks retail traders the most into entering the market. See here where we entered? And if I drop down to 1 hour time frame, again, this was a pending order. I gave this out just after FOMC. This big wick here, just like non-farm payroll I showed you earlier on GU, big wick up to the upside, big wick to the downside. Remember I said tip? Price will come back to retest those non-farm payroll, FOMC, CPI, the highs and the lows that it makes. Here was the high on FOMC. Check check my timing, check it on your chart. 7 o'clock, 1900 hours, Wednesday the 18th of June. That was FOMC. So that was the high made, and then that was the low made down here at 8 o'clock. Then price closed. 1 o'clock, I gave out this level around this time. And then we woke up in the morning. When I woke up in the morning, my level had been hit. That's the beauty of sniper levels. You're not entering a market execution. There's no panic. There's no, worrying. You place our orders and let price come to us. Price hit our level here, and then we started moving into profit. And as you can see, we've been moving into profit ever since. Price initially came back up to take out the FOMC high over here, which again, you start trading your eye, was a range once again. So you can see here, price took out the top of the range, came back down, tried to come to the bottom of the range, but managed to keep going higher because the overall trend was higher and we knew that price could go back up. So if this was our understanding that why we were getting into this trade is there was a range here, 0.1, 0.2, 0.3 driving down. So we expand this to the bottom of our range. This low is now the bottom of our range. We expand to the downside. So where's our target? Especially if you watch the last course lesson on our YouTube channel about ranges, you know where our next target is, and it gives you confidence to hold. That's the whole point. Most retail traders can't hold their trades because they've got no confidence in what they're doing. They don't know what they're doing. Every time there's a bearish engulfing candle against a long trade, they panic. Every time there's, the opposite of what they want to see, they start panicking. But here, I don't care what price does. It's going from one place to another, and I have confidence to hold it and know that I can get big trades. We're only talking 5-6 trades here, including a 1% loss. We're talking 30% profit. Here we've had 5% move down, and then here we entered there after FOMC, which is a time where the market tries to trick the retail trader, tried to bring them into selling this. We long this up to the upside, and this was just over a week, Thursday to Friday. We hit on Friday, just gone, a couple of days ago, 10%, 10 to 1 risk reward. You can see again, pull this range tool across, price came up to the top of that range, pull back slightly, and then boom, up to the upside. So that was a beautiful, beautiful 10% move. So 10% up, 8% down, 5% down on USD. Again, these levels all given in advance. Sniper levels given in advance. Sniper level short, sniper level long. Hit during the night, woke up, we're in profit. Beautiful. GBPUSD, all these levels you can see in front of me, we're given in advance. This level here, 1.33961, where we made 8%. 1% loss given in advance as well, but 1% loss there. Then this short here, 1.35759, given in advance, 8% there. And then we also have a new move that you may have seen on my story last week. So same thing, very similar here again. First sniper level was actually here, and we entered here, as you can see, and then that hit 2%. But as I mentioned on my story, that actually closed at break even. But then what did we do? Remember, it was closed at break even. We simply re-entered once again. Sniper entry. You can see that pinpoint 1.37696. Tap that to the pip. No drawdown. That's the beauty about sniper levels, and then selling off. So we wanted to show you this, but we also want to talk about the psychology. The psychology of the market, and what we teach, the foundation of innovation market, is teaching you the psychology, the tips and tricks and methods and principles that we teach, allowing you to enter the market at the correct place, allowing you to hold the trade longer for more profit. This is, as we see in front of us, one trade up here 3%, one trade here 8%, another trade 8% and 1%. 1, 2, 3, 4 trades, and in USD 5, 6. So 6 trades, 5 wins, 1 loss, but 30% overall. Now the problem is, for most retail traders, as we mentioned, they'll hold a loss. We've all been there, we've all done it at the start of our trading journey, but a lot of retail traders continue to do it. They keep holding, they keep holding, they keep holding these losing trades. But then when you're in a winning trade, they don't know how to hold these trades. But holding trades is from having confidence in what you're doing and have a full understanding of the market. Here isn't everything that we teach our members. Obviously, we can't give away everything, but we're giving some insights and are trying to help as many of you as possible. But when you really understand how the market works, many of my course lessons, for example, one course lesson, which is one of the members' favorites, is support and resistance, how it really works. And again, you'll think that might be so simple. Everybody knows what support and resistance is, but believe me, they don't. Because when you see it the real way and how the market really works, along with trend lines, range tools, and everything else we teach, timings in the market, specific times, it completely and utterly changes your whole view on the market and make you realize that everything that you know as a retail trader, most of it is lies. And it's no wonder that retail traders fail because, as I said, they are taught the complete wrong set of tools from the very, very beginning. And they don't have confidence to hold trades longer. You know, they still stuck in the circle of death with ego trading, not being able to take a loss, not being able to take that 1% hit and just move on. But here you can see 6 trades. Each of these trades had a maximum of 1% risk. 1% risk per trade. That's all you need. And you can make 30% profit in just 5-6 trades. So hopefully you've enjoyed this. Hopefully that's helped. Hopefully you've learned something from this today. I hope so. That's the whole point of doing this video. And yeah, we will do more videos in the future. I wasn't sure if you'd like me to do a video like this. I did put a poll out on my Instagram. I got a lot of great feedback, so I thought I'd do it, see how it goes. If you'd like this sort of stuff, let me know in the comment sections. Please subscribe as well. And the more, support we get, the more videos we'll do, because then we'll know that you guys like them and want more, and then we'll obviously do more if we get that feedback. So I hope that helps. I hope that makes you excited to take what I've shown you today and implement it, back test it, try it next week, and hopefully give you lots of sniper entries and lots of profit. So I look forward to doing the next video. I hope that helps. Thank you guys, and speak to you soon. Bye bye.